Welcome to Unfoolish Investing, everybody. I'm Victor.
I'm Larry.
Ah, episode 9, Larry. Episode 9.
It just keeps going, man. We're
It
just
just really,
rolling.
when we last left, the market was continuing to go up to end August for our fourth winning month in a row. And then September happened. Larry. How do you feel about September so far?
I think if you look back statistically, September is not ever really a good month for stocks. Um, so this just seems like par for the course. Um, Nvidia did go down 10% yesterday.
What can you do? Nvidia was bound to come down. It's in that place where
Mhm.
everything's uncertain. But today we're here to to talk to everybody about our principle at Unfoolish Investing, and that is, can you guess it?
Set it and forget it.
That's right. That's right. And this is our core concept. Essentially, um, hands off the approach to investing. It means setting up your investments, putting them on autopilot, similar to your Tesla, if you have that. I don't. And then letting them grow over time without constantly checking in on them, not tinkering with them. That it's a simple idea. By consistently investing a fixed amount on regular intervals, whether it's daily, weekly, monthly, you're taking advantage of dollar cost averaging. What are your thoughts?
This is how I manage my own personal portfolios. Is everything is set up to just invest. I do everything on a weekly basis. I do have some monthly investments though, but they're all set up to just automatically, come out of my account and invest in whatever the market price is that day. There's no limit orders. There's no thought. I've done the thinking already in the past that I like the stock that I'm buying.
Is it
Um,
is it kind of like you're on a beach, on a chair, holding an
yeah,
umbrella drink?
I've got my Dutch Bros. The Broista was great. I got my mocha. I'm on the beach, and the money's just coming in.
Amen. Amen. And I think that is the key to the magic of automatic investing, um, especially with dollar cost averaging. You buy more shares when
Mhm.
prices are low or when shares are high. But over time, they average out. So the impact of
Yep.
market volatility is next to nothing. And
Right.
that's the best part about set it and forget it. You're not stressing over the ups and downs. Like the media yesterday. My God, the market dropped 600 points. Who cares? Who cares? Moving on with my day. Don't stress
Right.
out over it because you have bought in at the bottom, you've bought in at the top, you're dollar cost averaging in, you're taking the stress out of it. And you don't have to listen to the crazy people in the media be like, everything's falling apart. You can just be like, I'm good. I'm good. I'm an unfoolish investor.
Yep. To your point, when the market goes down on the days that when I have buys set up, I'm like, hey, I just got in a little cheaper.
Yeah, and that brings us to part two of Set It and Forget It. And that's the power of automatic investing. And, we touched on it just a few moments ago a little bit. But when you set up your account to make regular contributions, um, I think both of us use SoFi to do ours. You can contribute to your portfolio in a variety of different ways. Whether or not I have some coming into my SoFi account from my paycheck, I have others come in from my bank account. Um, you know,
Hmm.
the money gets
Yep.
invested without you having to do absolutely anything. And that's the beauty of it. Um, I love SoFi because of the fractional share buys. Because I think a lot of people see a stock like CrowdStrike and they're like, well, I don't have $260 to buy that stock. Well, with SoFi and its fractional share option, you don't need to wait till you have enough money to buy a whole share. Buy $5, buy $10. Yesterday, I bought $30 worth of CrowdStrike stock. It was $262 when it executed, but I didn't even realize it was executing. I was working, and I get the email notification that I just bought more shares. And you can start at SoFi with as little as $1. $1 can get you investing.
Yeah, so I used to use E-Trade. I still have an account on E-Trade, but you made a great point about fractional shares. You can't buy fractional shares on E-Trade, and that's what really drove me to SoFi. Um, you to your point, there's not really a minimum amount, a dollar, um, that you can set up to invest automatically on a regular cadence. That's how I've basically set up my investing from here on out. Is almost everything is automatic outside of some, you know, outlier event that happens where I either want to add immediately or sell immediately. Other than that, everything is just automatic. It comes out of my bank account into my SoFi investing account, and like you said, I don't even really think about it. It just happens, and I get the email, and I'm like, oh yeah, that happened. Okay, moving on.
Yeah, and I want everybody to understand that you don't have to use SoFi just because we do.
Hmm.
There's M1 Finance, another fantastic platform for those who want maybe a bit more customization in their portfolio. You can create what they call pies, which I didn't
Yeah,
really vibe with, but they're just visual representations. Stocks and ETFs can all go into these pies. Have you used M1 in the past, Larry?
I used to use it. Yeah, and then kind of to what you said, I didn't really care for the basket approach, or the pie approach. I liked to have all of my individual stocks laid out instead of investing. In my head, I thought of it like a pie, so I call them pies. It just didn't really work for me visually. It was a good platform, though. It kind of helped me to understand how automatic investing works, and the visual was cool. You know, how how your portfolio evolves over time as you keep investing and the values of stocks either go up or down. So I think it's probably a good beginner platform. I personally prefer SoFi, but M1 was a good learning experience for me.
Yeah, and I mean, I think like SoFi, M1 allows you to schedule investments on a daily, weekly, or even monthly
Yep.
basis, because it also does support fractional shares, which we
Right.
both agree E-Trade does not. And that was one of my core reasons why I stopped buying stock through my E-Trade account and moved
Yep.
over to my SoFi account.
Yep.
Is I really wanted fractional shares to be able to be purchased in more than just index funds. Because E-Trade
Hmm.
allows you to do automatic investing with index funds, but I wanted the ability to create my own index fund. And, you know, M1 does that, SoFi does that, but there's another player out there that's very popular, and it's also pretty much associated with active trading, and that's Robinhood. You can set up recurring investments, whether or not it's in ETFs, and Robinhood will just handle the rest.
Mm-hmm.
I think Robinhood, to me, is a good platform similar to M1 for beginners.
Yep.
Like, if you're looking for a very simple, straightforward platform, I think Robinhood fits that. But if you prefer more customizable options, M1 Finance also does that.
Mm-hmm. Yep.
But I truly believe the simplicity of SoFi, you know, gives you that more well-rounded experience, and it has so many different jumping off points that once you get in, you can have a bank account that's also with a high yield. So I do that
Yep.
with my SoFi account. I don't believe M1 or Robinhood offer that option. If I'm incorrect, feel free to leave a comment, showing me where I was wrong there. But when I have that paycheck automatically drop in, I now have a savings account with a high yield of 4.5%, which is
Yeah.
just phenomenal return on your money from a savings account aspect.
Yeah. I think Robinhood might have that as one of their. I think it's called Robinhood Gold. They'll give you. It's not necessarily. I guess it functions like a savings account, but it's just any money that's in your investment account that's sitting in cash. They'll pay. They'll pay you interest on. But Robinhood Gold, you do have to pay a monthly fee for. Whereas SoFi, you're not paying a fee. One thing I'd like to say about Robinhood is I think Robinhood really opened up investing to the masses. Before that, there was a lot of trading fees. You had to pay a fee just to buy a stock. And fractional shares were still a new thing when Robinhood first came out. So, Robinhood, while it's not my favorite platform, I still do have some crypto holdings in Robinhood. But they really helped push they made investing much more accessible to regular people.
I I I'd get behind that 100% because I remember the days of set it and forget it investing where I had to think about how much fees I was going to pay a month, whether or
Yep.
not it was $8 per transaction or $16 per transaction. It never used to be free. But to your point, Robinhood really did push the industry to overhaul itself, and I think that the reason why E-Trade, Merrill, Fidelity, you name it,
Mm-hmm.
even SoFi, are all free today. It's because
Yep.
they saw what Robinhood was doing and they were like, we're going to lose so much money
Yep.
to these people because we're not doing it for free.
Yep.
And so we've pretty much covered a lot so far in the set it and forget it, how to use it. The one area that I want to touch on next is the importance of compounding over time. We've talked about this in the past, but this is to me where things really get exciting. And I love to get excited about compounding. Um, you know, Albert Einstein reportedly called compound interest the eighth wonder of the world. I'm not sure if you knew that, and for good reason. Compounding is the process where the earnings on your investments generate what? Their own earnings. It's like getting free money. In other words, you're making money on the money you've already made. And, we've talked about starting off with a low amount. And I mean, say you just invest $500 a month into the stock market at an annual rate of 7%. After 20 years, you would have invested $120,000, Larry. But
Mhm.
this is where it really gets exciting. This is the sexy part. This is the sexy part. But thanks to compounding, your investment wouldn't be worth $120,000. It would be worth $260,000. Over $140,000 of profit just by letting your investments compound over time. And that's why I tell parents, start compounding your children's future at birth with just as little as $50 a month. Just as
Yeah.
little as $50 a month. And then if you do that for just 20 years, maybe 21, you'd have roughly $52,000 that you would have saved up and compounded for them. Then you would never have to add another penny to that. And you
Mhm.
just let that continue to compound for them until they're 60. They have over $2 million, Larry. $50,000 turns into $2 million over the next 40 years.
Yep.
That is why compounding is so important and why you need to start early. Thoughts on compounding, Larry? Sorry to run on. I love compounding.
No, no. One of my favorite lines, if you look at rates of return over a long period of time, if you invested $1,000, and this is just a singular one-time investment, if you invested $1,000 on the day Warren Buffett took over as the executive of Berkshire Hathaway, you would have $44 million in September of 2024 on $1,000,
That's insane.
which are are a lot of companies going to be able to replicate that rate of return? No, I don't think so. Um, but it's a great story of putting money into something that you believe in and letting it grow over a period of decades, and you will get positive, potentially life-changing returns, whether that's for you, for your kids, for your grandkids.
Yeah. I mean, I can't follow any of that up. That is just some mind blowing numbers right there. Um, but I
It
think,
took 60 years, but $1,000 one-time investment became $44 million.
yeah. And if you're seeing that rate of return, even if you want to take a little along the way,
Mm-hmm.
you're still playing with millions of
Yeah.
dollars in earnings after 30 years, 40 years. Like
Mm-hmm.
you're dealing with so much money that it just shows you the importance of compounding and and what I want to call our last step, which to me is the critical one of any unfoolish investor, and that's staying the course. Staying the
Mm-hmm.
course. It's about being patient. Like you have to be patient. Don't watch the media. Like don't panic when the media is putting up the flashing signs. The market is falling apart. Like that's not
Yeah.
unfoolish, right? We're patient. We're dollar cost averaging. Markets are going to go up. They're also going to go down. It's far more exciting for the media when those markets are going down, just like it's far more exciting when you're on Top Thrills Dragster and you get to the top of the hill and you're going straight down. That's a huge rush right there. But that's a period of excitement mixed with periods of fear. I mean, and if you've set automatic investments and committed yourself to a long term strategy, the best thing you can do is what? Stay the course. Stay the course.
Yeah. Staying the course, honestly, is that's the hardest part for almost everyone. You've already made the commitment to buy the stock. You've done that. eventually you're going to want to sell the stock or pass it down to somebody, like your kids or your grandkids or whoever. The hard part is holding through all that volatility, and your point about the sexy media story. Yesterday, September 3rd, we come back from the holiday weekend in the US. Oh my God, everything's down. The chip industry's dead. AI is dead. There's no earnings from AI. Nobody knows what's going to happen. So Nvidia's down 10%. All the chip makers are down. Absolutely nothing changed in the fundamentals of those companies between last week and this week. So you might, oh my God, Nvidia's down 10%. I got to dump it before it goes down anymore. All you've done is locked in the loss. So it's one of those moments where you just take a breather, move on. And if you're in the set it and forget it mindset, where you just have your investments automatically set up and you don't look at them, you might not even know that dip occurred because you're committed to the investment. You don't have to watch it every day.
It's so true. It's so true. And it's, it drives me crazy when people are like, well, I got to time the market. No, investing isn't about timing the market.
Nope.
It's about time in the market. Time in the market, not timing the market.
Yeah.
And by constantly utilizing set it and forget it, right? You're giving your money the time to grow. You're setting yourself, you're setting your children up for long-term financial success. Heck, you can even set up your dogs, your cats, do whatever you want, whatever makes you happy, Larry. But it's time in the market, not timing the market, right? If you're investing in VOO, QQQ, Berkshire, whatever stock it is, right? Whatever index, give it time. Don't worry about what the media is doing. Media is always going to try to scare somebody or make, ignore them. Ignore the outsiders.
Yep.
There's a good chance they're not unfoolish and they're not in the market, or they're getting paid by somebody to scare you to try and go sell your stock. Don't do it.
Yep, all good points.
I just wanted to leave, jump into one other area. And that for me is compound interest, right? And this is, I just want to throw this out one time, right? We talked about the $50. We talked about the contribution amount of $50 a month, right? And we're going to be super conservative, Larry. 8% annual return, right? As I said, after 20 years, you would have $28,683. After 21 years, you would have $31,599. Now you take this. You never give your child another penny, right? You throw this over here, zero out, nothing else for them, right? So they're getting no more contributions, and now they're only 21 years old. 40 years later, they're going to have, when they're 61, if it's super conservative, they're going to have $686,000 from that $31,599. That is just at an 8% rate. Now, if you want to put it at the average, over the last decade, QQQ, which is the NASDAQ 100, has returned an average return of 16%, right? VOO's a little bit lower. So if we just knock that number up just a little bit to 10%, 10%, I still think 10% is conservative because traditionally, over the last decade plus, the market has done better. That 650,000 is now 1.5 million, right? If that tweaks just a little bit in either direction, 11% is 2 million. 9% is still almost $1 million. When they're 60, and that is time in the market. That's the compounding, Larry.
On one lump sum investment,
Yeah.
you made all those returns. Just like my earlier example. It's I think a lot of people just need the education and need the visual example, because it's tough to fathom without seeing it. Oh, I have $30,000. And if I just put it into the stock market, forget it exists, I could have millions of dollars.
And I want to give a big shout out to my favorite compound interest calculator on the web, and that's NerdWallet. NerdWallet, I love you. Thank you for this compound interest calculator, because to me, it really does help show people what time in the market can do, what the potential is. And I want to thank everybody for joining us on this episode of Unfoolish Investing, the set it and forget it strategy. Hit like and subscribe. Stay unfoolish.